You can run a highly profitable, rapidly growing business, report record earnings, and still go bankrupt by Friday. This happens because growth consumes cash before generating it. The faster a company accelerates, the more friction it creates internally, until the financial structure snaps. When companies collapse at this stage, it is almost never because the founders lacked a compelling vision. Failure begins the exact moment the story they tell about their growth starts to override the actual numbers in their bank account. The trap lies in what we call profit logic. Accrual accounting records revenue the moment a deal is signed or a service is rendered. It does not wait for the client to actually pay the invoice. Relying on profit logic creates a massive blind spot. Founders look at income statements showing record profits, while their actual cash reserves drain to zero. They are navigating by a metric that hides insolvency right up until the moment recovery is impossible. To survive, a business must operate on cash logic. This means tracking the literal movement of liquidity into and out of the firm over time. Cash holds absolute priority. Profit is a measure of past economic performance. It tells you if your business model works in theory. Cash flow dictates whether your firm physically exists tomorrow. This scale weighs cash flow against profit. You cannot pay payroll with accrued revenue. Notice the profit side fills with invoiced sales, looking healthy. But simultaneously, actual cash drops, as immediate expenses are paid before those invoices are collected. Founders routinely misread this exact dynamic. They see the rising invoices and assume they have incredible momentum, missing the fact that every new sale is actively draining their reserves. Scaling a company based on accounting profit without mastering the physical movement of cash is a mathematical trap. It guarantees the business will eventually run out of capital. The primary engine of this financial stress comes down to a simple mechanical problem: the timing gap between money entering the business and money leaving. This graphic visualizes that timing gap, showing the asymmetry between cash inflows and outflows as two separate conveyor belts operating on completely different clocks. Look at the top belt, representing cash inflows. These are inherently probabilistic. Even with a signed contract, an invoice can be delayed 45 days, tied up in approvals, or disputed. You operate on an unpredictable schedule. Now compare that to the bottom belt. Outflows are strictly deterministic. Payroll hits on an exact date. Rent is due on the 1st. The tax authority does not care if your clients are paying late. These obligations are fixed. When a company scales rapidly, this gap physically widens. You hire more staff and buy inventory to fulfill new orders, increasing deterministic outflows immediately. But the cash from those new sales remains trapped in receivables. This means business growth is a financing event. Every additional unit sold requires you to front the cash for its production and delivery until the client finally settles their bill. Ignoring the physics of this timing gap leaves a company completely exposed. The firm exhausts its reserves and is forced to seek expensive external debt or give up equity, stripping the founder of their operational control. That exposure is compounded by a second structural vulnerability: the accumulation of fixed costs. These are the long-term leases, the expanded payroll, and software subscriptions added during growth. These obligations are rigid. They persist at the exact same level whether revenue doubles or drops to zero. A high fixed cost base severely compresses how much time management has to react to a crisis. This diagram illustrates fixed costs as a literal anchor on the business. They define a firm's fragility profile by locking in future cash exits, regardless of what the market does. Focus on the breakpoint mechanics section here. The flat red line represents those unyielding fixed costs, while the yellow line represents revenue. The moment revenue dips below the fixed costs, the firm crosses a critical threshold. Crossing this breakpoint triggers a nonlinear acceleration in cash burn. The drain on liquidity becomes so fast that minor adjustments, like trimming a marketing budget, are mathematically ineffective. Founders often assume they just need a small bump in sales to recover. The math proves otherwise. Once that breakpoint is breached, incremental revenue won't save the business. Survival requires immediate structural amputations to the cost base. Maintaining a light fixed cost structure is a deliberate choice. You are trading maximum immediate expansion for a wider reaction window, buying the time needed to ensure long-term survival. To manage that reaction window, disciplined firms rely on a single, uncompromising metric: the liquidity horizon. The liquidity horizon answers one specific question. Exactly how many weeks can this business survive if absolutely nothing improves? This chart outlines runway maths. The core calculation is simple. Take your available cash today and divide it by your weekly net cash burn. The result is your liquidity horizon. Notice the key variables on the left. You must use only cash currently sitting in the bank. You strictly exclude any undrawn credit facilities, expected external funding, and uncollected pipeline revenue. Optimism is removed from the equation. This calculation creates clear behavioral thresholds. As shown here, if the horizon drops to 8 weeks, all discretionary spending is immediately halted. If the horizon hits 4 weeks, the firm enters a mandatory restructuring phase. A hard hiring freeze takes effect, and rigid costs are dismantled. Calculating this horizon in weeks, rather than months or quarters, is entirely intentional. A quarterly timeline feels abstract and invites procrastination. A weekly timeline forces immediate executive action. Runway maths strips away narrative hope. It forces leaders to stop forecasting their desired future and start operating within the uncompromising physical boundaries of their actual cash runway. The greatest threat to a firm's runway is the psychological state of its leadership. The intense optimism required to start a company becomes a fatal bias during a cash crunch. Under stress, leaders naturally shift away from structural rules and start relying on intuition. They overweight positive signals, like a potential new contract, and underweight negative evidence, like dwindling reserves. This leads to a trap where founders begin negotiating with themselves. They delay necessary layoffs or cost cuts, convinced that salvation is just one big deal away. Instead, they trade mathematical certainty for pure hope. To protect the firm from panic, disciplined organizations rely on an engineering solution: pre-programmed decision rules. Decision rules break the cycle of delayed human reaction by linking signals directly to actions. As this diagram shows, if cash drops below a threshold, an immediate spending freeze executes without debate. Similarly, if margins fall, discounts are suspended to protect liquidity. These strict rules act as external governors. They remove the burden of choice at the exact moment a founder's judgment is compromised, preserving the firm's existence through structure rather than willpower. Rules only work if they are enforced. That enforcement happens through a strict operational routine: weekly cash governance. This routine revolves around a 13-week rolling cash view. 13 weeks is precisely long enough to expose upcoming liquidity cliffs, but short enough to prevent teams from inflating the numbers with pipeline speculation. This chart lays out the protocol's strict calculation order on the right. The unforgiving sequence never changes. Start with the opening balance, add only confirmed inflows, and subtract only committed outflows to find the ending balance. Nothing else is considered. This weekly review is not a strategy session, it is an execution mechanism. If the ending balance breaches a liquidity threshold, the predefined decision rules are activated immediately. This relentless weekly cadence forces leadership into a constant confrontation with raw arithmetic. It catches rising costs and delayed payments in days, destroying behavioral drift long before it becomes a terminal crisis. Entrepreneurship constantly requires a difficult psychological split. Generating a vision requires absolute freedom and optimism, but executing that vision requires ruthless, unyielding rigidity. Many founders let execution run wild. True discipline instead forces the chaos of daily operations into a rigid channel, creating stable, forward momentum. A compelling vision attracts capital, talent, and attention. It points the firm in the right direction. But when pressure peaks, only strictly enforced mechanical financial discipline guarantees the firm will exist tomorrow.